Hello everyone, Professor Christensen here. Today we're going to see an overview of the statement of cash flows. So our learning objectives, when you're done with this statement of cash flows chapter, you should be able to identify the purposes of the statement of cash flows, distinguish among operating, investing, and financing activities, prepare the statement of cash flows by the indirect method, and use free cash flow to evaluate business performance. So what is the statement of cash flows? It is a financial statement, just like the income statement and balance sheet. And its purpose is to show us why cash went up or down during the year. So if you take a look at this piece of a balance sheet. Remember, our balance sheet shows assets, liabilities, and equity. And here in our current assets section, we see that in this company, Runner's World, that our cash went from $451,000 up to $502,000. So you could see that by looking at the balance sheet. The question is, why did cash go up by $51,000 in 2025? Why did it go up? So remember these numbers because we're going to be using them again. And if you want to come back again and look at this balance sheet, we're going to be using pieces of this as we prepare our statement of cash flows later. So the question is, why did cash go up in 2025? And it could be, why did cash go down? But the statement of cash flows is going to show the cash inflows and outflows for the company for the year. This is a summary statement of cash flows. So when we're all done, it's going to look much longer. The one that we have at the end is going to be much longer. But this is just to show you the overview of what the statement of cash flows looks like. Notice that it has, of course, a three-part heading like all of our statements. It is for a period of time, like the income statement. So it is for the year ended. It has three sections. It has operating activities, and those are always listed first. Then it has investing activities. Those are listed second. And then finally, financing activities. When you add up your operating, investing, and financing activities, so these are netted together, and this works all throughout the statement. You have increases in cash and decreases in cash, and you add the increases and subtract the decreases. So this 51,000 is the 125 minus the 40 and minus the 34. So our reminder, cash inflows are added and outflows are subtracted. So an inflow would be, for example, you sell some equipment, right? If you sell something, you get money. Think if you sold your car, right? If you sold your car, you would get some cash. If you bought a car, you would pay cash. Same idea here, all right? So outflows are subtracted, inflows are added. Remember that we said that cash had gone up by 51,000. And what this is showing us is, well, why did the cash go up by 51,000? So this increase or decrease in cash agrees with the balance sheet. And then finally, at the very bottom of the statement, you take your increase in cash, add it to your beginning cash balance, and you get your ending cash balance. Now remember, this could also be a decrease. So we're always netting. So you might be adding or subtracting, okay? And these cash balances, remember, agree with the numbers that we just saw on our little piece of the balance sheet. All right, so let's look at what goes in each of these sections, and then we're going to look at the sections in detail. So operating activities come from revenues and expenses from operating the business. We use what's called the indirect method because that's what most companies use. And the indirect method begins with net income, and then it adjusts net income for items that affected cash differently than they affected net income. And we'll see some examples of that as we go on. So just remember that operating activities come from the income statement. Investing activities come from transactions in non-current assets. All right, so think of non-current assets. Remember, those are assets that last for longer than a year, generally speaking. And we have examples here. So purchases and sales of property and equipment. Purchases and sales of long-term investments. Loaning money to another company or another person and getting repaid. Those are all investing activities. We'll see how they work in detail shortly. Finally, we look at financing activities. Those are cash inflows and outflows from long-term liabilities and in equity accounts. So anything that affects long-term liabilities or equity would go in financing. Examples are issuance of common stock. Remember, when you issue stock, the stockholders give you money, so that makes your cash go up, right? Repurchase of common stock, which if you're going to hold on to it, is called treasury stock, and that requires cash, right? Issuing and repaying bonds, that's of course money coming in and also money going out. And finally, payment of cash dividends. Those are all financing activities. So you do need to be familiar with which transaction goes in which place, and that's one of the things that you're going to want to practice. All right, so now let's look in detail at how we prepare each of these three sections. Now, not a lot of detail, because this, remember, is an overview. There are 2 other videos there that will help you walk you through the whole thing from beginning to end. All right, so this is a typical operating activity section. Notice that it begins with net income, and net income comes from our income statement. Remember what's on your income statement: revenues minus expenses equals net income. So the net income comes from the income statement. Then remember we said we adjust net income to net cash from operating activities, and we have 3 things here, 3 items that come from the income statement that affect cash differently than they affect net income. Let's start with depreciation expense. Depreciation expense reduces your net income, right? You subtract it to get to your net income. But depreciation expense doesn't use any cash, so we add it back again. All right, we say, okay, well, we took out the depreciation expense from net income, but it doesn't use cash, so let's add it back again. All right, the losses and gains on disposals of assets, we do the opposite. And the reason we take them out is because we're going to account for those in the investing section. So the loss on disposal of land was subtracted from net income. We're adding it back. The gain on the sale of equipment was added to our net income, right? Gains are added, but we don't want to, we want to take that, negate the effect of the gains and losses. So we're going to take the gain out of our net income, subtract it. Now, down here you see current assets and current liabilities from the balance sheet. Changes in those current assets and current liabilities. And you'll see that some are added and some are subtracted. So you might be wondering, well, why are we adding? Why are we subtracting? So here's a little thing to help you to remember. Remember that with current assets, you do the opposite of the change. So what does that mean? Accounts receivable decreased during the year. It went down. We're adding the decrease. All right, let me say that again. Accounts receivable went down. We are adding the decrease. We're doing the opposite. Why? Because if accounts receivable went down, that means you got more money, right? You collected more money from your customers. So that works for all of these. So inventory went up, we subtract it. Prepaid expenses went up, we subtract that. Now, current liabilities are different. We do the same as the change. So if accounts payable went down, that means we paid more money, right? So we have to subtract it. So a decrease is a minus and an increase is a plus for current liabilities, okay? So remember, current assets, you do the opposite of the change. Current liabilities, you do the same as the change. Now let's take a look at investing activities. This is a typical investing activities section. We have a purchase of investments, we have a sale of land, and we have a sale of equipment. Notice that a purchase of equipment, if you have a purchase and a sale, it would be shown separately. So in this case, we don't have a purchase of equipment, we only have a sale. But if you had a purchase of equipment, that would be shown separately. And remember that we are netting these together, so we have a minus 67, a plus 15, and a plus 12. And if you take the 15 and 12 and minus 67, you're going to get a negative 40,000. And we call this net cash used for investing activities because we used the cash because it's negative. All right, so let's ask a question. How much did this land cost? Well, if we go back to our operating section, remember that we had a loss on the sale of the land of $2,000, and we got $15,000 when we sold it. So here is the cash piece of it, right? And we had a loss of $2,000. So the land must have cost us $17,000 because when we sold it, we got 15 and we had a loss. All right, finally, we're going to take a look at financing activities here, and we have three different examples of financing activities. We have an issuance of common stock. Remember that means cash has come in. We repaid some bonds. That means whenever you repay a loan, the company's paying money out, so that's a negative number. And then we paid cash dividends of $24,000. So again, you net these together. You have 15 minus 60 minus 24 gives you a negative $34,000 cash used for investing activities. Let's put all this together now. All right, remember I said that the statement of cash flows was going to look much bigger right at the end than it did at the beginning when we had that little summary one. So these are the three pieces that we just did, and we put them all together. Generally, you're going to see we put the totals over here to the right, because it makes it very easy. You see operating, investing, financing, add those three together and you get your increase in cash. Okay? And so that's what your final statement will look like when you're all done. So there are some transactions that do not affect cash, but do affect some of our non-current accounts and equity. Examples of this are buying equipment and signing a note. Not paying any cash, you're just buying the equipment and signing the note, or issuing stock in exchange for land. These items are not reported on the statement, like we just saw, the statement we just looked at, but we would put them either in a note at the bottom of the statement, or they would be reported in the separate notes to the financial statements. So these items are reported, but they're not reported on the statement of cash flows, because the statement of cash flows only shows things that affect cash. All right, our last thing we want to take a look at is free cash flow. And free cash flow is a measure of how much cash from operating activities is left after paying for capital expenditures and dividends. Now, hopefully you all know what dividends are. Those are distributions to our stockholders. Capital expenditures are purchases of property, plant, and equipment type assets. So the company bought some equipment or bought a building. Our free cash flow formula is net cash flows from operating activities minus capital expenditures and minus cash dividends paid. So for our particular company, we had net cash flows from operating activities of $125,000. They did not have any capital expenditures this year because they only sold. So we don't have to worry about capital expenditures. So we're just going to take operating activities minus the cash dividends, and that gives us this company's free cash flow of $101,000. Let me just mention one last thing very quickly. I want to go back to this statement of cash flows. Notice that you do want, when you're analyzing a statement of cash flows, you do want to take a look at where the company is getting its cash from, and also the increase and decrease in cash. And a lot of people like to compare the net income to the net cash provided by operating activities and see if there are big differences there and what those differences are. So remember, when you look at a statement of cash flows, you want to say to yourself, where is this company getting its money from? And of course, at the very beginning, a company has to get its money from financing activities because they might not have a lot of operations. But you do want to take a look at where companies are getting their money from and where they're spending it. All right, so that's all we have. I think you're all ready to study your chapter materials. Thanks for watching. Happy studying, and I'll see you in the next video.